Welcome to the CTP exam prep platform. I'm Ernie Smith. In this section, we're going to go through Chapter 20, the capital structure decision and management. And in this chapter, we're going to talk about how we determine the optimal blend of equity and debt for your capital structure. So we'll talk about the capital structure, how to raise and manage your long-term capital, the weighted average cost of capital, lease financing, equity financing, and then we'll talk about a few other miscellaneous corporate finance strategies here. So let's get started. As we mentioned, the capital structure is that mix of debt and equity that makes up the long-term financing for your organization. And the right mix can make or break the organization. So when we talk about the capital structure, it's important first to talk about the characteristics of debt and equity, and we'll get into that. And then we'll talk about kind of how we determine what is that right mix. As you might guess, there's a calculation for that, or at least a theory. So we'll talk about trade-off theory, and then some of the factors that influence the target capital structure and capital structure for not-for-profits here. So let's talk first of all about some of the characteristics of long-term debt financing. You've heard the question earlier, what's cheaper, debt or equity? Well, in most cases, debt is going to be cheaper, and there's two reasons for that. First of all, debt has a tax advantage. In other words, the cost of debt is interest, and interest payments are tax deductible. So if a company is generating a positive net profit, then the cost of interest will be reduced by the amount of taxes that they save. Another reason why equity is typically cheaper than debt is because equity holders are taking less risk, greater risk than the debt holders. So if you look at the priority of claims, the equity holders are last in line, the debt holders are first. And as a result, since they take more risk, the equity holders require a greater return. Some of the other characteristics of debt, typically your debt markets are pretty efficient. So that means you have a pretty good range of debt products, debt providers, and you can tailor some of the repayment characteristics. Usually, though, you'll have some limitations on management flexibility. Because you've got a fixed cash flow that you have to service that debt, that's cash flow that gets diverted away from other opportunities, as well as liens and potential covenants. One of the biggest challenges with debt is that debt holders can force bankruptcy where equity holders cannot. So the greater the amount of debt in your capital structure, the greater the potential risk of bankruptcy. Now, as we look at equity and some of their characteristics, one is the cost of equity. As we mentioned, equity is going to be more expensive than debt because the equity holders take a greater amount of risk. So that's the potential downside. But on the upside, you have more potential flexibility for management. The return for the debt holders, typically dividends, and management gets to decide the amount of dividends and when to pay the dividends. Plus the fact that most equity does not mature. It's evergreen type of financing. So it has a lot more flexibility than a structured debt payment. Now, equity also, though, involves potential control of the company. In the case of common stock, equity involves voting rights. And so if you're an equity holder, you do have some say in the operations of the company. It can also be more expensive to issue equity than debt because you have to go through the SEC, you have to do the upfront filings, and as a result, it's typically issued in larger amounts than debt. You have the concept of earnings dilution also. And what that means is if I am an equity holder in a company, as new equity is introduced, then the value of my existing equity holdings is reduced as a result. Let's say we have 4 individuals that each have common ownership in a company. That means you're going to have 25% ownership for each individual. If I bring in a 5th investor, Now every investor owns 20%. So me, as one of the original 4, I've seen my ownership percentage go down from 25% to 20%. And that's what we mean by earnings dilution. Now, one of the ways that we can also generate equity, though, is through retained earnings. As we generate profits, we can either give that profit to the equity holders, or we can retain that profit within the company to use for other things, and that's retained earnings. And so if we have access to retained earnings, that'll be cheaper for us than issuing new stock, and you don't have the problems of earnings dilutions or ownership dilutions. All right, so let's talk about the capital structure theory. How do we determine what the optimal capital structure is? Well, the capital structure theory is also known as the trade-off theory. That means we're going to trade off debt for equity until we get the lowest overall weighted average cost of capital. Okay? And so we're going to assume we start off with a company that's got 100% equity. And that cost of capital is going to be highest. Let's say the cost of capital in that case is 14%. Okay? As we go to the bank and we borrow some money, the bank is going to be, look at us pretty kindly because we have a lot of equity in the company. We have no debt. So they're going to make debt available to us at attractive terms. Let's say they charge us a 5% rate, or whatever the term that's attractive for the particular market. So that's going to bring down our overall cost of capital. As we go back to that same bank at a later date and borrow more money, they're still going to look at us favorably, but they're going to charge us a little bit more because debt makes up a larger amount of our capital structure. So our overall cost of capital, weighted average cost of capital, may still come down, but not as much as it did the first time around. As we continue to go back to the debt market, the amount that we pay for our debt is going to continue to increase. And there will be a point where the amount that we pay for the debt is going to be greater than the weighted average cost of capital. And in fact, that means if we get some additional debt, our weighted average capital will increase. And so that's what we mean here. As debt is substituted for equity, WACC first decreases, and then at some point it rises. And that point at which it starts to rise is going to be your optimal capital structure. Okay? Now, again, you're going to have to take into account some other things like firm and industry factors, and we're going to talk about that in slides that come here. But we're going to utilize a couple different terms, though. We're going to talk about optimal capital structure, and then we're going to talk about target capital structure, because those two may be different. The optimal capital structure tells us theoretically, without taking into account any of the real world issues, the capital structure that we should have. Okay? Whereas the target capital structure is the one that we manage towards when we take into account other issues. And some of the other issues that we may take into account are things like earnings volatility. If we have a lot of volatility of earnings, then that might mean we have maybe a little bit, different capital structure than what the optimal might suggest. If we have, like a lot of intermediate long-term financing needs, that might mean we manage toward a little different capital structure. We look at other things like, the risk tolerance for the company, the credit impact, the relative cost of debt and equity. These are all going to work into what we determine to be our target capital structure. And oftentimes the target capital structure might be arranged. So if we do the calculation and the optimal capital structure is, let's say, 40% debt, 60% equity, we might, as an organization, decide our target capital structure is going to be between 30% to 35 or 40% debt. So we have it in a range. And so the target capital structure might look like something like this. In this case, we have a company that has set its target capital structure between 40 and 60% debt. Okay, that's where they want to stay. So as they get out here with 100% equity, they're going to want to layer on additional debt as they go toward the target capital structure. They're going to continue to do that until they get up to this range. Now, when they're in this range, they still have some debt capacity, because remember, they said they wanted to get between 40 and 60%. So if they want to layer on some additional debt, they can still do that. As they get closer to this range here, they're going to have less debt capacity. They're getting closer to that 60% range. So if they need to add any additional capital, they're probably going to look more toward equity. Okay? So this is an example of a typical target capital structure. Now, as I mentioned, there are some things that will determine the difference between a target capital structure and the optimal capital structure. We mentioned one was the risk, the stability of cash flows for debt payment. So if you have a lot of fluctuation in your cash flow, maybe you get a little bit less debt. Okay? If you look at asset structure, if you're an industry that requires a lot of assets, a lot of fixed assets, that might mean that you change, your target capital structure to accommodate that. Okay? One of the big things, as we mentioned, is shareholder control, shareholder dilution. We know that new equity dilutes control, it dilutes the value of the existing shares. So the equity holders are not always thrilled about layering on additional equity, and that might point toward more growth or more debt. If you're in a very profitable company where you have a lot of potential retained earnings, you can actually utilize that to increase the amount of equity, and as a result may have a little bit more equity in your target capital structure than your optimum. And then things like market conditions, what are the relative advantages of debt to equity in the current market? Are the debt markets illiquid? Those kinds of things you take into account. Lender rating agencies, as you get more and more debt, the lenders get conservative, the rating agencies actually charge more for the debt, and so that may increase your cost of debt and may mean that you take less debt in your capital structure. And then in some cases, you're going to have minimum capital requirements. If you think of a bank, for example, there's a minimum level of capital that they're required to have, and there's a requirement that some of that is equity. And so that might also actually change your target capital structure, and make it different than your optimal capital structure. Okay, so as we talk about debt and equity, one of the things to also consider, if you're doing equity, how are you going to manage dividends? And this can be a challenge, particularly if you have dividends going from a parent company, from a subsidiary to a parent company. The challenge here is when you transfer the profit from the subsidiary to the parent, okay, the way that you transfer the profits can actually reduce the amount of profits that you transfer. Because when the subsidiary generates the profit, it's going to be taxed at the subsidiary level. And then as you transfer profit to the parent company will be taxed on dividend income. And so you always have to take into account the taxes and regulatory restrictions when you're transferring from the subsidiary to the parent company, particularly if you're transferring cross-border. Okay? Some of the other things to take a look at is if you have a blend of debt and equity to where you have a lot of debt and a little bit of equity in the subsidiary, then that allows you to transfer less of your income as dividends and more as interest payments. However, you run the risk of having thin capitalization. And in some countries, they look to see the level of capitalization because they are concerned about companies transferring interest and principal payments as opposed to dividends. And so that might get you some additional scrutiny here. And then covenant impact. If you are borrowing, particularly from a lender, one of the areas where they'll typically have covenants is the level of dividends that can go from the borrower to anybody else, particularly a parent company. And so there may be a restriction on the amount of dividends that you can have. Okay. And so, again, you want to take into account all of these as well as the tax implications. You don't want to have double taxation if you can avoid that. You want to manage the amount of taxable income to reduce that. So, definitely make sure you get a tax expert involved and have a good tax strategy. And when we talk about a tax strategy, we're talking about a global tax strategy. So, if I've got subsidiary, in Japan and one in the United States, I am not just going to look at, okay, well, what is the Japanese strategy? I'm going to take into account how the two companies or two countries work together to try and avoid double taxation, if at all possible. There's the risk that I will be taxed on the earnings that I make in Japan. Those dividends go to the United States, and I get taxed again. And so I want to try and avoid the double taxation as much as possible. The other thing that I'm going to try and do is, as I transfer funds from the subsidiary to the parent company, I want to do it in such a way, although it minimizes the potential tax, I don't run into a problem that we call deemed dividends. In other words, if I structure a cash flow from the subsidiary to the parent company in such a way as to avoid taxation that would be charged on a dividend, if one of the countries of the subsidiaries or the parent company were to see that, they could say, okay, well, you're trying to avoid taxation. We're going to deem that a dividend, and we're going to charge you taxes as if it had been a dividend. So I want to avoid the deemed dividend issue as much as possible. Okay? And so, particularly if I'm doing business between the two subsidiaries, maybe I'm purchasing things, in the Japanese subsidiary from the United States subsidiary, I want to make sure all the transfer pricing is at arm's length. Otherwise, the jurisdictions might come back and say, hey, again, you're trying to reduce taxation. We're going to deem it to be a dividend. So I need to take both of those into account here. And finally, I also need to understand the business and financial position because, each subsidiary is going to have needs for capitalization. Okay? It needs to fit in our operating strategy, international, and I need to understand the ramifications in all the countries of operation. All right, so as we talk about the repatriation of capital by MNCs, multinational corporations, okay, there's a couple ways that we can restructure kind of the dividends payment. And this is an example of some of the things that governments may actually look for. Okay. In most cases, the foreign subsidiary pays dividend to the parent. The jurisdictions are happy because they see that as a dividend payment and can tax it accordingly. Okay. Now, in some cases, the government might want to restrict capital going out of the country. And so there may be things that we call, like lifting taxes or transfer taxes, where if I send money from one country to another, the transfer of those funds is actually subject to, rules, regulations, and taxations. And so we need to take that into account. But if we assume that we're dealing in jurisdictions without, the restrictions, there still might be ways to kind of recharacterize our cash flows. Again, if we're looking at a Japanese subsidiary of an American company, the American company can actually charge management fees. Let's say the American company says, okay, we're going to charge you $10,000 a month as a management fee for services provided from the parent company to the subsidiary company. And that's an additional $10,000 a month that transfers back to the parent company, and that is an expense on the subsidiary company's income statement and may actually have a tax advantage. So that's one way that we can actually get cash flows going back to the parent company. I mentioned also transfer pricing. This is one area where it can get a little bit sticky. If the Japanese company is buying widgets from the American company at $10 a widget, but the government finds out that everybody else buys widgets at $8 a widget, then they're going to deem that extra $2 a widget as a deemed dividend. And so you need to make sure that the transfer pricing is not significantly higher for the subsidiary than it is for other companies that are purchasing from the parent company. And then one of the other ways we can structure this is by limiting the amount of equity that we put in the Japanese subsidiary. So if we need, let's say, $100 million in financing for the Japanese subsidiary, instead of putting in $50 million of that as equity, we could put in, that whole $100 million as an intercompany loan, 100% debt. That means any of the repayments then are characterized as interest payments or repayments of principal. And those have different tax ramifications than dividends. Again, some countries look for that thin capitalization as a way for companies to kind of get around the dividend taxation, and so that might be an issue. But this is another way that you can kind of change the capital structure to your advantage here. Okay, so here's your next discussion questions. Section 956 of the U.S. Tax Code requires a U.S. shareholder of an offshore financial corporation of a U.S. multinational corporation to currently include in income its pro rata share of any increase in the earnings of the offshore financial corporation that are invested in U.S. property. This is a what? A, transfer pricing issue. B, deemed dividend issue. C, intercompany loan issue. Or D, restriction on dividend issue. Well, as we parse this out, this is not really talking about payment of dividends. So we're not talking about monies going between the corporation. So this is not a restriction on dividend issue. And as also, along the same lines, it's not an intercompany loan issue. Okay? And since we're not talking about transactions between parent company and subsidiary, it's not a transfer pricing issue. So this is an example of a deemed dividend issue. Basically, we're saying that the company is going to have this amount of its income deemed as a dividend, and so they will be taxed on that amount of issue. So the correct answer here is B. Now let's take a moment here to talk about, because up to this point we've talked about for-profit entities and kind of their capital structure. How does that discussion change if we're talking about not-for-profit entities? And there's a couple ways that it changes. First of all, the concept of equity for a not-for-profit entity is a little bit different. Okay? In a for-profit entity, the equity represents control and ownership of that for-profit entity. In the case of a not-for-profit, the equity does not represent the ownership of that particular not-for-profit or the control of that particular not-for-profit, because they can't go out and sell ownership. So any equity that you see is represented from one of two sources. One, as that not-for-profit goes out to the market and solicits grants and donations, that represents equity capital. And so the overage of the amount that they receive as grants and donations and the amount that they pay out for services is equity. The other way that they generate equity is by actually accumulating as a result of their activities. And so if they have a revenue generating activity, the difference between that revenue generating activity and their expenses that represents profit then goes into equity in the form of retained earnings. And so their retained earnings is going to be excess of basically the revenues coming in and the expenses going out. Now, the other thing is that they can't issue common stock. Okay, so that's going to limit the amount of equity that they're available to actually take advantage of. So it's going to be primarily grants, donations, and profits that they generate. Oftentimes the debt financing that does have a tax advantage in that it can be the tax exempt, so that can be attractive for them as well. Yeah. So as a result, their target debt levels might be a little bit different. The short-term debt might be facilities that are set up to do their operations, whereas long-term debt is going to be more to support property, plant, and equipment, and so it might be different than their optimal capital structure based on their ability to raise that long-term debt. Okay, so as we talk about debt and equity, we also have to think about how are we going to raise those funds. Are we going to go to private placement? Are we going to go public? And what are the advantages and disadvantages, both of them? And remember, you can have private and public debt placement as well as private and public equity placement. Okay, so we're talking about both debt and equity. Now, the advantages of going public is that you have a diversification in terms of your equity holders or your debt holders. And so you can have a lot more liquidity if you're in the public markets. It makes it relatively easy to raise funds. Because you're public, you have greater transparency into your organization, and so the potential investors can have greater confidence. And it makes it a little easier to do things like spinning off parts of your organization. Now, of course, the disadvantage is that you have to have a lot more disclosure to go public. You have to do registrations with the SEC. They will dictate the financial information that you have to provide and what form you need to provide it. And there's a cost to that, so it can be more expensive. You can also have limitations on management flexibility, because if you're a public company, there's things that you are required to do to safeguard your shareholders that you don't necessarily have to do as a private company. Okay? And you may actually run the risk of giving up a lot of control over your company, particularly if you're doing equity. The fact that you have more information out in the industry, you have more investors out in the industry, means that you may also actually create a takeover opportunity for your competition to either come in and buy up your existing equity or come in and buy up your existing debt here. So that being said, what is the main advantage of public offerings? One, access to capital markets has potential to raise large amount of debt and equity at growing rates. Two, low costs in managing the reporting, disclosure, and rating agency requirements. Three, low cost of filing 10Ks, 8Ks, and 10Qs. Or D, investors want more equity in exchange for greater risk and lower liquidity. Well, as we look at this, we've already mentioned that the cost of filing information like 10Ks, 10Qs, and the like is actually higher. So you have a higher cost of filing 10Ks and 8Ks. You have a higher cost in managing the reporting, disclosure, and rating agency requirements. So that's a downside of going public. Let's look at the last one. Investors want more equity in exchange for greater risk. We've already mentioned that if you're a public company, you have more disclosure, more transparency, and investors see it as a lower risk. So this one is not correct either. Okay. So the correct answer here is going to be A. Access to capital markets has potential to raise large amount in debt and equity at going rates. As we talk about equities, there's another decision that you may need to make. And that is how to sell the equities, whether you're going to sell them on an organized exchange or you're going to sell them over the counter. And there's some advantages and disadvantages to each. One of the biggest advantages to an organized exchange is the fact that you have to do more disclosure, and as such, the market is additional transparency. That is an advantage to the investors, and as a result may increase the market ability of your stock. Now, that's also a downside though, because the requirements for disclosure are higher, they're more expensive, And as a result, some companies decide to stay on the over-the-counter market, and there have been some companies that actually start an organized exchange and then delist from the organized exchange so that they don't have to put up with the additional requirements. But as an advantage, the exposure gives you more sales and potentially at better rates. Because you're seen as a less risky investment, the investors don't require as high of a return, and it can lower your weighted average cost of capital. Okay. Some of the other decisions that you have to make: what kind of stock that you issue and how you issue it, and even how you value the stock. The example here is, if you talk about stock, typically you have one class of stock that has one vote for every share of stock, but that's not an absolute requirement. You can actually have multiple classes of stock with different rights to different shareholders. So Class A can have one vote per share, Class B can have one vote for every 2 shares, and so you have to decide if you have single, dual, or multi-class stock that you distribute. And even, it's not listed on the side, but whether you do common stock and preferred stock. We're going to talk about that in a few minutes here. If you think about how you value this, in other words, what price are you going to sell the shares at, there's also a couple ways you can do it. You can do an absolute valuation, where you look at the estimated cash flows from the stock and you discount those cash flows to come up with an economic value for that share of stock. Or you can do a relative valuation, where you look at companies similar to yourself and what they're selling for. So if you have 3 other companies that are very similar to yours and they're selling in a $3 to $5 range, that's probably where you're going to start as a IPO valuation. Okay? So there's a couple ways you can value the stock. And then you can also do what we call an ATM, or at the market program. Okay? And this means that you can actually create a stock issuance, have it approved by the SEC, but not necessarily sell it all at one time. With an ATM program, basically you can release a specific amount of equity over a period of time and just sell it into the market at the current market price. So this is what you'll also hear the term either dribble plan, a shelf registration. That means I've already got the approval to release the stock, and then I release the stock and sell it as needed to raise funds instead of selling the entire issue at once. One of the other choices you can make is whether you do a private placement or a public issuance, and this can be either debt or equity. One of the advantages of a private placement is you have more control. A private placement means I am going to a qualified, sophisticated investor, and then I am going to offer them the chance to purchase either the debt or the equity, as opposed to going to the public market. Because it is a transaction between 2 parties, in a lot of cases, sometimes a limited number of parties, the result is I can do it for smaller issue sizes. Okay? I don't have all the disclosure requirements, and as a result, then it takes me less time to do the issuance. And oftentimes I can have more flexibility, less restrictive covenants, okay, because I'm negotiating those directly with the investor. It also has lower costs, but one of the best advantages is that I can control who holds the debt, or I can control who holds the equity. And I don't wake up one day to find out that there's a particular investor that owns 40% of my stock and wants to buy the rest of my company. And so this is perhaps one of the best advantages over a private placement. And then the fact that we're negotiating between 2 parties means that the terms and maturities can be very flexible. Once we do issue either debt or equity, we have to have some infrastructure within our company to manage that outstanding capital. The investors, in this case, are third parties, and so we need to make sure that there's a trustee that is in place to manage and look after the interest of the third party. And so that's what we mean here when we say manage the trustee relationship. Usually you'll have a dispersing agent, and the disbursement agent will actually take hold of or take care of the payments to the shareholders, either common shareholders, preferred shareholders, or payments to the bondholders. And then you have investor relations, and they're the ones that maintain the records of the shareholders. They are the ones that will send out the financial statements, any of the annual reports. If I've got questions as an investor, either shareholder or bondholder, I can ask investor relations. They'll send out the regular communications, and then they'll do the roadshows where they go to the investing community and tout the value of an investment in this particular company. And in that way, they hope to keep the stock price up. So as we talk about equity, some of the things that can be attached to equity in the form of shareholder rights and features are the following. One, we mentioned that in most cases, an equity investment gives you some rights to control. And again, this can differ based on whether you have preferred stock or common stock. Typically, common stockholders are the ones that have control. Okay, and so the amount of votes you get per share of stock is a measure of the amount of control you get for your equity investment. And remember, we can have multiple classes with different levels of voting. Cumulative voting here is one of the ways that smaller shareholders can have a voice. And the way this works is like this. Let's say that we have 3 directors that are up for election this particular round. So as a shareholder, let's say with 1 share of stock, I would have the opportunity to vote 1 vote each for each of those directors. So cumulative voting says that instead of me voting in each one of those 3 director elections, I can take all 3 of my votes and vote for just 1 elector. And so that gives me potentially greater voice, and it gives the smaller shareholders the opportunity to at least vote for 1 director on the board of directors by putting their votes together. Okay? A proxy basically says that I, as a shareholder, can give the right to vote my shares to another person without selling my shares. And so if I give you my proxy, and I have 10 shares that represent 10 votes, then you can actually go and vote the 10 votes as if you own the shares. The staggered election of directors is one of the ways that companies can actually make it a little bit harder to change control. If I had 4 electors, 4 directors, and they all came due in 1 year for re-election, then potentially I can vote out all 4 of those directors in 1 election and replace the entire board. On the other hand, if I stagger the election, so one comes due 1 year, another comes due the next year, et cetera, it would take me 4 years to replace the entire board. So by having that staggered election, I can ensure more continuity of control. And then finally, the preemptive right is one of the things that we put in place to combat the issues with dilution. The preemptive right says that if I issue new equity, I go to the existing equity holders first and give them the right to purchase enough of that new equity to retain their ownership percentage. Okay? And so that gives them the right of first refusal to protect their existing percentage. All right, so as we talk about dividend policy, and in this case, we're talking about dividend policies from the company to individual investors. We're not talking about dividends between parent companies and subsidiaries. Okay? But when we talk about dividends to individual investors, how are we going to determine how much we pay? Well, one, we're going to look at the effect of the capital structure. Remember, we've talked about a target capital structure. And if we're paying out dividends, that is a reduction in the amount of equity in our capital structure. And so we want to make sure that we retain enough dividends in there to retain equity, but we also want to try and maximize shareholder value. Now there's a couple other key things to keep in mind here. One is the type of dividend that we have can help determine what type of investor we attract. If we have a steadily increasing dividend, institutional investors that are looking for dividend income will flock to our stock. On the other hand, if we don't pay out a lot of our earnings in dividends, then we won't attract the institutional investors, but we may attract those investors that are looking more for capital gains than dividends. And so the type of dividend we pay can help to determine the type of investor we get. There's also the concept of dividend signaling. If we pay a dividend of $2 in one period, the market is going to expect the next period dividend will be $2 or greater. And so if we pay $1.50 the next go around, the market is going to think there's some financial issues with our company, and we may lose shareholder value. So when we declare our dividend, we have to keep in mind what signal are we sending to the market. And so even though we may be able to afford a $3 dividend, we might just do a $2 dividend because we know they're going to expect some dividend growth for the next period of time. Okay? So again, dividend signaling is an important concept, as well as the fact that we attract certain investors based on the dividend that we have. As we talk about dividend, there's a few key dates to keep in mind here. The declaration date is the date that the board declares a dividend. So let's say the board meets on January 1, and they agree to pay a dividend on March 1st for all shareholders of record on February 1st. So January 1, that's the date that the board met. That's the date that the dividend was declared. That's the declaration date. The record date is the date at which we are going to open the records of shareholders and see who are all the shareholders of that particular date that are entitled to the dividend. So if we say for all shareholders of record as of February 1, that means on February 1, we're going to look to see, okay, who are all the shareholders of record, and these are all the people that are going to be paid the dividend. Okay. Now, the ex-dividend date is a date directly in front of the record date that recognizes the fact that if we buy or sell stock in that period of time, we need time to update our records. And so typically, 2 days before the record date is the ex-dividend date. And any stock that's sold after the ex-dividend date is sold without the entitlement to receive the dividend. Okay, so if the record date is February 1, your ex-dividend date is probably going to be January 29th, January 28th, somewhere like that. And then the payment date is actually when the dividend gets paid. Now, one of the other things you may have heard about is a dividend reinvestment plan. And the dividend reinvestment plan allows the shareholders to actually take dividends in the form of additional shares as opposed to cash. It's one of the ways that I can actually increase shareholders or share ownership, particularly among small shareholders. So if I, as a small shareholder, have 10 shares, but I continue to reinvest the dividends, I'm going to amass more shares, and I'm actually going to increase the size of my equity holdings. Okay? So typically on a dividend reinvestment plan, shareholders can actually reinvest the dividends in additional shares directly from the firm, or they can purchase additional shares, on a no commission basis directly from the firm. Okay? And these might be shares that the company has in treasury. We mentioned before, some companies have shelf registrations. They can utilize some of the shares from the shelf registered stock for dividend reinvestment plans. Or if they have to, they can go into the market and purchase the shares. So what are the different types of dividends that we have? Well, most of us are familiar with the cash dividends. That means that we're going to get X amount of dollars for every share of stock, and that's payable in cash. Very simple. Now, a stock dividend means that I'm going to receive extra stock for every share of stock that I have. So I may get, 1 share of stock for every 10 shares that I have. Now, I will say a stock dividend is very similar to a stock split in that if everybody is receiving a stock dividend, it really doesn't do anything more than reduce the potential price of your shareholders. And let me skip down here and talk about stock splits. A stock split is me basically saying, I'm going to give you 2 shares of stock for every share of stock that you have. That means that you have more stock, but every share that you have is worth 50% less. So if you had 1 share that was worth $100, now you got 2 shares, and each share is worth $50 each. So you still have only $100 worth of stock altogether. And the ownership percentage has not changed. This is one of the ways that companies can control their stock price. If they think their stock price is getting too high, they can do a stock split to get their per share price lower. Or they can do a reverse split if they think the stock price is too low. A stock dividend is basically saying, I'm going to give you 1 share for every 2 shares you own. If everybody gets it, your ownership percentage does not change. And so it's basically one way or another way of kind of bringing down that stock price. A special dividend is a way for us to get dividends to our shareholders without signaling the wrong information. Remember we said before, in the case of dividend signaling, if we pay a $2 dividend, then the market is going to expect higher than $2 the next time around. Well, let's say we come across some additional capital. Maybe we sell a subsidiary and we want to send that cash back to our shareholders, but we don't want to signal that this is an ongoing event. So we can say we are going to declare a special dividend of $3 a share. And so we're signaling the market that we're giving money back to the shareholders, but this is not going to be an ongoing event. And so the market does not get confused the next time when the dividend goes back to the $2 range. And then liquidating dividends, these are dividends that are actually liquidating the company. So if we're selling out assets of the company is ceasing operations, we're collecting receivables, we're sending that money out to the shareholders in the form of liquidating dividends here. All right, so here's your next discussion question. What is an important means of returning capital to shareholders that can be used as an alternative to paying cash dividends? And some of the key parts of this question I'm going to point out in a minute. Okay? But A, stock splits, B, special dividends, C, stock repurchases, or D, intercompany dividends. Now, some of the key things here is they talk about returning capital to shareholders, an alternative to paying cash dividends. Okay? Well, if you think about a stock split, there is no capital that goes back to the shareholders. Basically, just the value of your shares is affected. So there's no new capital going back, so this is not correct. Okay? If you think about a special dividend, okay, there is cash going back to the shareholders, but it is not an alternative to paying cash dividends because a special dividend is a cash dividend. So that's not correct. In an intercompany dividends, there's no capital going back to the shareholders. So the correct answer here is stock repurchase. Okay? Basically, as the company buys stock back from shareholders, the shareholders get cash. Okay? But it is not a cash dividend per se. Okay? So they're not taxed as dividend income. All right? So let's talk about a couple other concepts when we talk about capital structure. We're going to talk about mergers and acquisition and how that works. Okay? Merger and acquisition basically means that there are 2 firms that are going to come together. And in some cases, it's by mutual agreement. In some cases, not so much. Okay. So let's say I have two firms, firm A, firm B, and they look at each other and they decide, hey, it makes sense if we combine. Okay. That is a merger. Two companies come together. Oftentimes you'll hear the term merger of equals if they're relatively the same size. If that's the case, it's friendly because both companies work together to make the transition happen. And usually company A will let people from company B come in and do due diligence, look at their books, and vice versa. Now, an acquisition is when you have one company that actually that acquires another company. They're actually going to go about buy that company, blend it into their existing operation. And that can also be friendly. So company A can agree to be acquired by company B and become part of company B. And in that case, again, you still have the due diligence. Company A will let company B in, look at the books and all of that. But what happens if company A doesn't want to be acquired by company B? And what happens if company B still likes company A? That's when we go through a hostile takeover. That means one company is going to try and acquire another, even though that other company doesn't want to be acquired. Now, in this case, company A is going to say, well, B, you can't come in and look at our books, so you're not going to have the due diligence that we talked about before. Okay? But if company B still decides to move forward, they can actually take the case directly to the shareholders to try and force the sale of company A. And there's a couple ways that they can do it. One is they can do what we call a creeping tender offer. Okay? That means that they're going to go out into the market and quietly buy all of the shares of company A that they can. Okay? And based on that, they can develop an initial ownership position. So, let's say they go out into the market and buy as many shares of the company as they can. They have 25% ownership now of company A. Well, that's still not enough to force the sale. They're going to need at least 51% of the shares to be able to approve the takeover of company A, because they have to have company A's board basically approve it. So the next step might be a tender offer. If company A shares are selling at $10 a share, they go and get big ads in the Wall Street Journal, and they say company B is willing to buy as many shares as company A at $12 a share, in the hopes that the investors in company A will sell their shares. And if they get enough then to get 51% control, then they can vote for the takeover. But let's say they do the tender offer, they get another 20%, so now they have 25% from the creeping tender and 20% from the tender offer. They have 45%, but they don't have enough. The last step could be a proxy fight, where they go to the shareholders of company A and they say, this would be a real good investment for you if these two companies merge. You don't have to sell your shares, but give us the opportunity to vote your shares at the board. And if they can get enough shares to vote at the board, then they can force the sale. All right, so we've talked about some of the ways that they can force the sale. How do you finance the sale? And many of us have heard the term leveraged buyout. In the case of a leveraged buyout, that means that the sale is going to be financed with a high amount of debt. And oftentimes the thought is that the acquired company, the assets of the acquired company can sometimes be liquidated to pay for all or part of the debt that's used to finance it. Okay? Now, the downside is because there's a lot of debt involved, there's a higher amount of risk there. And typically, as a result, the debt that's involved is higher cost debt. Okay? That means if I'm the acquirer, okay, I'm going to go out and get as much debt as I can at attractive pricing. But if that's not enough for me to do the deal, then I'm going to get another level of debt that is lower rated, higher cost, in order to help me to do that deal. And if that's still not enough, I might take even lower rated debt. You've heard the term junk debt, which is high cost debt typically with a short amortization schedule, so that I have enough funds to enable us to do the deal. Then that enables me to buy all the shares, and sometimes enables me to even take that company private. So in terms of financing the transaction, I can do what we call an all-cash deal. I say, I'm going to, for every share of stock of company A, I'm going to give you $12. Or I can do a stock deal. For every share of company A, I'll give you a share of company B. Okay? A mixed deal, stock and cash, I'll give you a share of company B plus $2. Or I can do leverage cash, leverage debt, or a mixture of cash and debt, which means that I am going to have a fair amount of debt that I use to provide the cash for the purchase, or a large amount of debt that I use to actually complete the transaction. Okay? And then finally, I can also issue preferred stock, which has features similar to debt, but is considered equity. Cash for acquiring a firm can come from all of the following sources except. So, in other words, we've put together all this cash that we've used to acquire the firm. Okay, how are we going to acquire the cash? How are we going to pay that cash back? Okay, so A, cash from the acquiring company. B, excess cash from the acquired firm. C, cash from the sale of some of the acquired firm's assets. D, issuance of investment-grade bonds. Or E, issuance of below investment-grade bonds with no amortization schedule. Well, think about this. If I'm the acquiring company and I have cash on the balance sheet, I can use that cash to actually fund the investment. Okay? So this, because we're asking for except here, this would not be a valid answer. Okay? Also, if I'm buying a firm that has excess cash on the balance sheet, once I own that firm, I have the right to utilize that excess cash. So I can use that to also pay down debt, fund the acquisition. As we mentioned before, I can sell off some of the assets of the acquired firm to generate cash. Okay? Or I can issue investment-grade bonds here. Now, the key here is this last one, E. Issuance of below investment grade bonds with no amortization schedule. In most cases, because they are below investment grade, the investors are going to want to have a repayment schedule. Okay, so it will be really hard to issue the below investment grade bonds with no amortization schedule. So the correct answer here is E. Now, as we talk about other sources of financing, okay, lease can be considered another source of financing. And the reason why we say that is it's another way that we can, purchase or acquire fixed assets, although it's different from debt and it's different from equity. And so there's a couple advantages. One, we're familiar with the fact that in a lot of cases, leases can be off balance sheet, don't affect the statements. Not in all cases, though. We'll talk about that. Okay, but there's other advantages also. If I'm going into a new line of business, let's say, for example, I'm a grocery store company, and I've decided that I want to actually get into a business where I deliver my groceries to individuals in their houses. Okay, so for us, it's a new line of business, even though it's an offshoot of our existing line of business. Okay, now if that business does not pan out because I've leased the equipment I need to get into that business, let's say I need a fleet of vans. Okay, then if that business doesn't pan out, I can return those vans to the lessor and exit that pretty quickly. So that's an advantage. Also, the lessor gets lease payments from me as a lessee, and we both get a tax benefit. Okay? The lease payment is an expense for me. Okay? As we mentioned, it's a direct substitute for debt, so may not have a balance sheet impact. Okay? And one of the other things is, maybe I'm a great grocery store company, but I don't know anything about operating a fleet of vans. In this case, I may actually go to a lessor that actually takes responsibility for not only leasing the vans, but maintaining the fleet of vans. So they'll do all the maintenance, the repairs, and the upkeep. And so it can be very attractive for me to lease assets that are outside of my firm's area of expertise here. As we talk about the differences among leases, one is going to be the length of the lease period. And we're going to compare the length of that lease period to the estimated useful life of the asset. One of the reasons we do that is that it helps to determine what type of lease we have. Okay? We're also going to look at who is responsible for the maintenance and upkeep of the item, as well as the estimated residual value of the asset. And the residual value of the asset is important because the lease actually finances the difference between the original value and the residual value. So if I have an asset that's worth $40,000 at the beginning of the lease, and I assume it's going to be worth $20,000 at the end of the lease, then the lease itself is going to be structured based on that $20,000 difference between the original and the residual value. And if that residual value is lower, then the lease payments will be higher as a result. Okay. And then who retains the assets at the end of the lease and the lease terms? And that also can help determine what kind of lease it is. Now, as we talk about different types of leases, there's what we call a capital lease, which is kind of like if you can think of a rent-to-own, as opposed to an operating lease, which is a pure rental. Okay? And the operating lease is the one that does not have balance sheet implication. OBSA stands for off-balance sheet arrangement. Okay. On operating lease, the lessor actually retains the asset at the end, and typically these are for shorter duration, okay, smaller portions of the asset's life. Okay. As we get lease terms that are closer to the estimated useful life of the asset, we get closer to the capital lease. Okay? And in the case of the capital lease, the lease itself, okay, now gets put on the balance sheet as a liability, as well as the value of the leased property. Okay? And so you can see the balance sheet treatment is a lot different. Okay? And that ties back to topic 840.10.15. Basically, we restate the balance sheet where the leased asset is a fixed asset and lease payments are liabilities. Okay? Now, it's an alternative to borrowing to buy, as we mentioned. The residual value is the estimated value at the lease end, and in some cases, your lease payments are adjusted for payments that the lessor has to, or the lessee has to make. So, for example, a double net lease may be the lease amount minus payments for taxes or payments for utilities or things that get subtracted from the actual lease payment. Now, before we leave this slide, let's talk a little bit about this, the sale and leaseback. Okay? In a sale and leaseback transaction, this represents a transaction where I have a company or an individual that actually owns an asset. And that individual will sell that asset to me, who will then turn around and lease that asset back to the individual or back to the company. Why would we do that? Well, there's a couple of reasons why you do that. One, if I, as the owner of the asset, let's say I'm in a position where I have a negative net income. I may have positive cash flow, but I have a negative net income. Okay? Well, that means the value of depreciation is not as high because depreciation offsets my taxable income. And if I have a negative taxable income, then depreciation really doesn't offset that, doesn't give me the tax benefits. Okay? So if I can't use the depreciation tax benefits, I'm better off selling the asset to somebody who can use the tax benefit. So I sell it to somebody who can use the tax benefits. As a result, I actually get a cash infusion that I can use for other things. And so oftentimes this can be very useful for those that are looking for cash infusions. All right, so we talked about the fact that capital leases can show up on the financial statement. How do we determine what is a capital lease? Here are some of the things that you look at to determine whether or not it's a capital lease. Okay? It is a lease that meets one of these conditions. One, the length of the lease is at least 75% of the estimated useful life of the asset. Remember, we talked about the closer the estimated useful life of the asset is to the length of the lease, the more it's probably going to be considered a capital lease. If there is a transfer of ownership to the lessee at the end of the lease, then it's probably going to be considered a capital lease. That's why I think of the term rent to own. Okay? If the lease agreement has a bargain purchase provision, okay, at the end of the lease's life, that's probably going to be a capital lease. Or the present value of the discounted lease payments at the beginning of the lease term exceeds 90% of the asset's fair market value. So basically, you're financing the majority of the asset's market value. In those cases, it's going to be considered a lease payment, or capital lease, rather. All right, next discussion question. Why do Treasury professionals track estimated residual value for leased assets and ensure proper maintenance? A, residual value is built into most lease arrangements, and potentially high residual values can increase lease payments. B, lease may require payments of the difference between assumed and booked residual value. C, lessee has primary claim on the asset's residual value. Or D, residual value may impact lease's tax status and off-balance sheet listing requirements. Okay, well, let's think about this. Remember, we talked about the lease payment is going to represent the difference between the original market value and the residual value, the estimated residual value. And we used the example where we had a $40,000 asset, and at the end of the lease, the estimated residual value is going to be $20,000. And so the lease would actually be based on that $20,000 difference. If the residual value was lower than that, let's say the actual value turned out to be $10,000, then the leaseholder has the right to come back to the lessor and say, hey, you owe me the difference between what we thought the actual residual value was going to be and what the actual residual value turned out to be. And so if there's a big difference, that can be an additional payment. So let's kind of parse this out and think about this here. The correct answer here, though, is actually D. And let's walk through this. The residual value is built into most lease arrangement, and potentially high residual value will actually decrease lease payments. Okay, the higher the residual value, the lower the lease payments. Okay, the lessee has primary claim on the asset's residual value. That's not correct. The lessor, the person that is leasing, has the claim of the residual values in most cases. Okay, this last one seems correct, except for some of the words. The lessee may require payment of the difference between assumed and book residual value. It's the difference between the assumed residual value and the actual residual value. So book in this case is the word that makes this incorrect. So the correct answer here is D. So how do you determine whether to use a lease or to purchase, assuming all other factors are equal? Well, if you're trying to make that determination, again, you can go back to the time value of money tool to help you make that determination. And what you would do is to look at what all the cost flows are going to be for purchasing that asset. What's the initial outflow? What are the payments for interest? What are the principal payments when you have to make them? What are the maintenance payments? And you would discount all of those and calculate the net present value. You would do the same for the lease payments. What are the lease payments? What are the ending lease payments? Is there a maintenance, or is maintenance, part of that? And you would calculate the net present value for that as well. And you would compare the net present value of leasing versus the net present value of purchasing, and then go with the one with the better net present value. And that's how you do your lease versus purchase So that's the end of Chapter 20. We've gone through capital structure, we've gone through raising and managing long-term capital, weighted average cost of capital, lease and equity financing, and then a couple other corporate finance topics. Thank you.